Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, looks like stocks are taking a little bit of a breather right now, which of course introduces the question, what is the next catalyst for this market?
Oh, just a couple of inflation reads and the FOMC.
Yeah, we'll see. Of course, Bitcoin, it doesn't seem to need a catalyst. So let's get right to the biggest stories in the more than $12 trillion global ETF industry. And like I mentioned, Bitcoin topping $72,000 for the first time. It's rising for a sixth straight day, taking year-to-date gains to almost 70%. That is on the back of massive inflows into ETFs.
We'll touch on the Bitcoin boom and the other top market themes of low volatility coupled with the record highs in stock indexes with Marianne Bartels of Sanctuary Wealth.
And we're also going to look ahead to tomorrow's U.S. CPI print and next week's Fed decision. We discuss bonds with Paul Bayaki of SS&C Alps Advisor. But as always, before we get there, Eric Balchunas from Bloomberg Intelligence. He's here with us now looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. You talked about Bitcoin price going up on the back of the ETFs, and I have the data here to show it. So we look at 1 week flows, right? Look at number 3 and number 4, IBIT, FBTC. Those are two Bitcoin ETFs. That is a lot of money because remember, there's 3,400 ETFs, and you have these only 2-month-old Bitcoin ETFs really rubbing elbows with the big dogs up here with VU and IVV, right? So this is a lot of money going into Bitcoin. It's completely, I think, surpassed many of our expectations. VU at the top is also good. We talk about the equity markets being comfortably bullish. The flows show this as well. You got VU up there, IVV. And then I want to go down to bots. Bots is interesting. I want to go back to that in a minute. Robotics and AI has kind of had a third life since NVIDIA, and that's the leading theme this year. So people are actually pointing more bullish with the themes they're picking as well. Let's look at the outflows. And Q's at the top. You don't want to see that. That's obviously not great. But again, net, I think we're bullish here. GBTC, that is part of the Bitcoin story. Those Bitcoin ETFs taking in a lot of money. Some of it's coming from GBTC, but it's netting more than that. And then we see some treasuries on here, which is good, in gold. GLD outflows, I think the Bitcoin ETFs have sucked up a lot of the oxygen because gold's actually doing well, but not seeing the inflows. In fact, it's seeing outflows. Let's look at the sectors and themes right now, just to get a gauge of the first quarter and where we're at beyond just like beta and bonds and stocks. Here's the actual sectors. Tech by far leading with $2.8 billion of the $3.7 billion into all sectors. So that's over half into tech, and $1 billion of that is semiconductors. Huge change from last quarter. And then you've got some other sectors that you would argue are somewhat bullish: healthcare, discretionary, and then the more bearish sectors are seeing outflows. And look at themes: robotics and AI. $1.1 billion into that. You could almost carry that and put it into tech as well, given those are a lot of the same stocks. Again, this is the NVIDIA effect taking over the sectors, Katie. So again, pretty bullish, I have to say, overall, whether you're a Bitcoin or a stock guy.
All right, pretty bullish overall, comfortably bullish, as we learned last week. Let's keep this conversation going now with Marianne Bartels. She is Chief Investment Strategist over at Sanctuary Wealth, joining us now. And Marianne, let's start with tech, because as Eric walked us through, overall, of course, tech is sitting on some pretty big inflows, Marianne, but you are starting to see some money leave the sector, especially in the last week. How are you thinking about tech at this moment? Is it time to rotate out, maybe take some profit, or is that the place to be?
No, we think that's the place to be. That's the leadership of this bull cycle. And if you dive down, we think it's really semiconductors within the tech space that are the true leaders. But I would want to point out that flows are very important and a good leading indicator of where markets are going. So when you're seeing such strong volume with the price action longer term, that's really a really bullish sign. We just think there's a little bit of profit taking that's happening in here, but we've been saying pullbacks are a buying opportunity.
Pullbacks are a buying opportunity for those who may want to start looking at some more depressed areas of the market. The small caps have been beckoning for a long time. We've seen or we've heard of all this excitement about the rotation into small caps, but it hasn't really played out when it comes to performance, right? Because of the Russell 2000 is still trailing the big caps. How are you thinking through investing in small caps?
So we have not been bullish small caps. We've been bullish mega caps. We still think that this is a large cap, mega cap cycle. And cycles like this can last 15 to 20 years. So it's not unusual to have trends, last this long. I understand that small caps are attractive based on valuation, but they're heavily weighted towards financials, particularly banks. And we don't see those as leadership. We think that they have an overhang not just because of some of the recent stress in some of the regional banks, but some of the regulations that can come down on the banks could make them somewhat less profitable. So we don't see them as leaders. Now, you always want to have a diversified portfolio. So if you have some small caps in your portfolio allocation, that's okay. But we don't think they're going to be leaders within this market. We think it stays mega cap.
And Marianne, I looked through your 13F, a lot of interesting ETFs in there. I know you love the Qs, that one's at the top, but you also had ARK in there. You know, ARK is an interesting fund. It had its heyday back during the pandemic. I had that huge drawdown, then it had a run up. It's like a more volatile version of the Qs. Can you explain a little of the logic behind that holding?
Sure. So just, for Qs, I think the way to look at Qs is we call it the digital index. In fact, in Dow theory, you used to like to have the Dow hit a new high and then transports confirm. But we think the real transports or the real measure of the economy is now digital, which is the Qs. And you did have the Dow reach record all-time highs and the Qs reach all-time highs. As for ARK, it is a diversified portfolio in terms of an ETF, but it does have some very heavy weightings in particular stocks. And when if those particular stocks that it's very heavily weighted towards are not performing, it weighs down the ETF. But if that weighting of that stock actually happens to do very well, then it does very well. So when you're really looking at ETFs, you really want to look at what's in there and what are the weightings. Even though you might have a diversified portfolio of names, you may have a stock or two that it's very skewed to, so you're going to move more like that stock than maybe the basket of stocks.
And Marianne, of course, we're talking against a backdrop where crypto has just been on fire. You take a look at Bitcoin right now, up another 4% today. It is above $72,000. And a lot of people are pointing to enthusiasm around the spot Bitcoin ETFs as one of the big reasons why we're reaching these records. When you think about the massive net inflows that we've seen into these products, of course, $10 billion or so on a net basis, how are you thinking about that? What are you feeling about crypto right now and just the enthusiasm that we're seeing around these products?
Well, let's remember a couple of years ago, there was no enthusiasm, and we saw some of these names go down 80%, 80. These are extremely volatile instruments. And I think they've already had their bear market, and now they're going into another cycle of their bull cycle. When it comes to Bitcoin, it has something that's called the halving. Every 4 years, miners get paid less in Bitcoin. That happens in April. And every time, and we don't have a lot of examples, we only have about 3 of them, but every time we've had it halving, we've seen Bitcoin go up and go up substantially. So I'm not surprised that we're seeing inflows. In addition to that, you now have 11 ETFs.
Yeah.
And as you mentioned, IBIT is getting a lot of funds. And I think that individual investors now having easier access is also driving the performance.
So one thing I want to bring up here, and Eric, this is something that you've talked a lot about, is this movement towards betting against volatility. Things have been pretty calm. The VIX right now at 15.5. It's a far cry from the low 20s that we saw in late October, and of course above 26 about a year ago. What are we seeing when it comes to ETF inflows, outflows, and ETF trades?
Yeah, so there's a new XIV, but it's pretty small. So I think going short VIX futures, there's nowhere near the money we had back in 2018 when Volmageddon happened. But there is a big boom in using options, like in JEPI, where you sell call options, but they're only exercised if the market goes up. In a way, you're giving up your upside. And Marianne, I wanted to ask you about something like JEPI and this idea of using options to give up upside to get income. What do you think of this trade? Are you in it? I think this is maybe for older investors.
I mean, this process of, selling calls to create income, it's not new. It's been around for a long time. And again, I think it's really important for clients to diversify a portfolio, or if they're looking for income, to diversify their sources of income. So even if they wanted to utilize this ETF, I wouldn't just utilize it by itself. That's, everybody, there's risks to everything. And so I would want a diversified portfolio of income.
All right, Marianne Bartels, really appreciate your joining us today. Marianne Bartels with Sanctuary Wealth. We do have some breaking news. President Biden, of course, releasing his fiscal 2025 budget. It's a $7.3 trillion plan, a proposal really that lays out his vision for his next term. Let's bring in now Bloomberg's Michael McKee with some of the details. Mike, what'd you learn?
Well, Eric was talking about big money flows at the top of the hour. It's really a lot of money when you start talking $7 trillion. You're right, $7.3 trillion is what the Biden administration is proposing spending for 2025, the fiscal year, which begins October 1st. In 2026, that would go up to $7.4 billion. But there's some interesting spin to this because it is his priorities. The deficit would be $1.8 trillion in the next fiscal year, but then drop to $1.5 trillion, even though they're spending more money, and it would fall significantly as a percentage of GDP. Why? Because the president is proposing taxing the rich, raising the minimum tax for people who the maximum tax level to 25%. So they would have to make up a lot of the difference there, and that could that could be something that upsets Wall Street. Except everybody knows this isn't going to happen. This is all going to be sort of dead on arrival up on Capitol Hill. They're still working on the fiscal 24 budget. They haven't gotten that passed yet. Economic assumptions, they do have some new ones, taking into account the fact that we have seen improvement in the economy that wasn't expected when they first put these together. They now think this year GDP will be 1.7%, which is a little higher than they had forecast, but still pretty low. CPI goes down to 2.9. It's at about 2.4 now. The unemployment rate stays at 4% in perpetuity. That's an interesting one. And then when you look at the 10-year note yield, it falls to 4.4%, not much.
All right, so a theoretical budget, but interesting nonetheless. Bloomberg's Mike McKee, thank you so much. Up next, we're going to go to China. More ahead on ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with GBTC. Of course, this is Grayscale's spot Bitcoin ETF. Since it converted to an ETF about 2 months ago, more than $10 billion has left this fund. Really interesting. That's actually the second worst year-to-date outflow behind SPY. So we're going to continue to keep an eye, of course, on GBTC. But let's also keep an eye on the Qs because we have a birthday to celebrate. We're talking about Invesco's QQQ. Of course, that tracks the NASDAQ 100. It turned 25 years old. And as you can see on that long-term chart, you can see the remnants of the tech bubble on the left side. You go to the right side, and clearly we are living in tech's world. So happy birthday to the Qs. Let's also talk about China. This is a really interesting chart here. You're taking a look at qualified domestic funds. So my understanding, of course, this is Chinese investors who can then invest outside of China. You can see the total AUM has just grown, as have the number of funds. Scarlett, I hope I got that right.
Yeah, well, let's get some more expertise on this and bring in Rebecca Sin of Bloomberg Intelligence. So qualified domestic institutional investor funds are growing in number, and they are putting more assets to work. Where are these funds going, Rebecca?
So what's happening in China is that we're seeing retail investors pour money into offshore funds. So these are the likes of MSCI USA, S&P 500. And the reason why is because the performance has done so well. So in China, the CSI 300 was down 15% last year. And Chinese investors are tired of this, and so they're looking to invest their assets elsewhere. And so we've seen a huge interest into foreign ETFs, especially actually ETFs listed in China with foreign exposure, so the likes of S&P 500. And because of this, these ETFs have started to trade at a huge premium. We're talking 10, 20, 30, 40%. So for instance, we have MSCI Japan that's traded at a 43% premium. And the reason for this is because in China, there's what's called a qualified domestic institutional investor quota. And for onshore China to buy foreign ETFs or foreign underlying, they have a quota on how much they can spend. And so all of these fund houses have now hit this quota. And as a result of this, they've halted creation. And the other thing that's unique to China is that in China, when an ETF trades at a 10% premium, the regulators will give a warning. And so for the first part of trading, the ETF is halted, and then there's a premium warning that's given. And what we found is that for ETFs that have more premium warnings, they actually got more inflows. And so that's why we're seeing this huge interest into foreign ETFs, and that's why these ETFs are trading at a huge premium.
And Rebecca, we don't have a ton of time left here, but I am just interested, going back to the growth, listening to you, it sounds like there's two dynamics here. One is that, of course, you take a look at some of these American-based indexes, they are outperforming. But then on the other side, of course, domestic Chinese equities have been disappointing when it comes to performance.
Yeah, so the performance has been disappointing. CSI 300 is down 15%. And because of this, the national team, which is the sovereign wealth fund of China, has started to buy ETFs onshore to help support the market. And this year to date, they've bought $41 billion worth of ETFs. And so this is a record number. To put this into perspective, onshore China 3 years ago only got $4 billion in new inflows. And so we're only at March, and they've already invested $41 billion. And as a result of this, we've seen huge inflows. So even if we look at inflows globally, the top 10 ETFs, 3 of them are from onshore China ETFs.
All right, so the national team pouring money into Chinese stocks while the qualified domestic institutional investors are chasing returns overseas. Bloomberg's Rebecca Sin, thank you so much. Still ahead on ETF IQ, we're going to drill down into bonds with Paul Bayaki of Alps Advisors next. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, take it away.
Katie, today we have an active bond ETF from Alps with the ticker SMTH because of the Smith here. You can see it's actively managed, yes, over there. It's fairly new. It's only a couple months old. The fee is 59 basis points, which is about average, I'd say, for a bond manager. It's big for Alps. This is one of their bigger products, 635 million, especially for the fact that it's less than a year old too. So what's going on here? Let's look at the holdings first. And obviously this is Core Plus, so it's going to be benchmark against the ag, but try to do a little better. And if you look at the cross section of this, two things stick out. First of all, it has more government and corporate holdings than the ag because it has very little mortgage. So it's underweight mortgage. That's a big thing to know. The duration about the same, and then you look at the composite rating here, the rating buckets, and you're going to have a little more high yield, maybe like 9%. That's going to give it a little kick. That kick is going to come in handy when we look at the comp chart here. So let's look at the returns of this fund, which is all that matters. If you're active, you got to beat the benchmark. So we're going to have the ag, and I put in the active Fidelity bond fund here, which has been a big hit, and then Jeff Gundlach's total. And this thing is beating all of them, especially the ag, but even these other two here. So that's the white line here. The high yield is probably going to give it a touch more volatility. But again, with returns like that, Katie, no shocker, this is climbing the charts for Alps.
All right, Eric, thank you so much. And joining us to talk about this ETF, I'm thrilled to say we have Paul Bayaki. He is Chief ETF Strategist at SSNC Alps Advisors. And we're going to get to the performance because that's impressive. But let's talk about the assets first, because, of course, 600 million, over 600 million in assets since the December launch is no easy feat. How much of that is organic growth versus maybe some of the mutual fund investors from Smith Capital coming over to this fund?
The vast majority is actually organic growth. And I think in many ways it's a tribute to Gibson Smith and the team he's built and the relationships they've built. The fact is that we launched mutual funds with them 6 years ago, and they've been able to grow that complex to north of $3.5 billion. But as you all have seen in a show like ETF IQ, the ETF wrapper is perhaps more flexible. It might be available at places where the mutual fund isn't. And so they've got this pent-up demand from investors who might have been using the mutual fund or looking for an alternative structure to the mutual fund. And we actually saw recently a really big trade come from a competitor's ETF in the active space and into SMTH, which is exciting and a tribute to what they're trying to do and how they're trying to do it.
Lower fees as compared to the mutual funds as well. So I want to ask you about allocation because, as Eric mentioned, right now it's almost half government debt. How do you see that shifting in the coming months as we anticipate the Federal Reserve cutting interest rates?
Well, I think Gibson and the team at SCI has always thought about their approach as old school bond management. It's not in esoteric products, it's not going to use derivatives. It's ultimately going to be using all of the levers available to them. You mentioned competing products who might be duration neutral to the ag. That's not the approach with SMTH. And it's important because most of the credit research that they do is sort of old school, fundamental, bottom up research. And in a market where you've got in the ag, 80% of the non-government credits trading at less than 100 basis points, option-adjusted spreads, when you've got triple B rated bonds trading at the lowest spreads or the tightest spreads since 2007, that type of fundamental research is really important, especially if you're just naively cap-weighted or market-weighted in credit or in the ag. And so SMTH's value proposition is you leverage this long track record of Gibson, former CIO at Janus, 30 years in the industry, the team he's built, but also an ability to pull a number of levers, whether that's duration, whether that's exposure to different credit buckets, and as well, different categories in fixed income.
And when you're out talking to advisors and potential investors, what are you displacing here? Are you able to actually peel out some ag out of a fixed income allocation, or is it all sort of more higher cost mutual funds that you're drawing from?
So I think it's a combination of all of those things. Again, there is a mutual fund suite associated with SCI that continues to service investors who use mutual funds. There's certainly the idea that you can enhance the risk return profile of a fixed income sleeve by using an active manager, so going against the ag, but also displacing other active managers. Like I said, one of the big trades we've already had in SMTH is someone moving off of a competitor's product. And I think the beauty of ALPS, generally speaking, is we've got a number of active capabilities in the real estate space, now in the fixed income space, in the muni bond space, but also this sort of intersection of active versus passive. People draw a line in the sand often, but what you have is often active implementation of passive products. Sector spiders are sort of the best example of that. You've got passive implementation of active strategies like OUSM, which we talked about, a quality dividend strategy, and then full-blown active.
And so you only have about 30 seconds to answer this question, but of course, SMTH, that's your largest active ETF. Should we expect more from you?
Sure. So REIT is an actively managed REIT strategy. We're just crossed over 3-year track record. It's a category where we think you can and should add value in an actively managed wrapper in the real estate space, public REIT specifically. And then we also have an actively managed muni bond strategy run by Brown Brothers, which is a tremendous strategy that we think will continue to grow. So we're excited.
All right, Paul, really enjoyed this conversation. Of course, that is Paul Baiocchi of SS&C ALPS Advisors. And if you just can't get enough of ETFs, a reminder, of course, you can listen to Eric and Joel Weber on Trillions. That, of course, is their podcast that covers the industry. But that does it for Bloomberg ETF IQ. I'm Katie Greifeld with Scarlett and Eric, and this is Bloomberg.